Okay, I think we'll go ahead and kick it off on the first presentation today of EnerCom 2023. My name is Austin Elam. I'm a partner at Haynes & Boone in our Houston, Texas office. So welcome to get out of Houston, and thank you, Dan, for the better weather than what we've been experiencing in Texas. It is my privilege to introduce Robert Anderson, who is the president and CEO of Earthstone Energy. Robert and Earthstone are no stranger to the city or the stage. Robert is a petroleum engineer by background with 30 years of experience, and he went to University of Wyoming for undergrad and then his MBA right here in Denver. Preceding his taking the helm at Earthstone about 3 years ago, he's been at Earthstone for a decade. He was at Oak Valley Resources in a senior leadership role, and preceding that at senior leadership roles at a number of public and private companies. As a personal aside, having worked with Robert for a few years, he's probably the hardest working person in the room, I can say almost without qualification. So with that, please join me in giving Robert and Earthstone a warm welcome in EnerCom.
Thanks, Austin, and thanks to EnerCom. It's a privilege to be the lead-off speaker, I guess, outside of the EnerCom story, which is great. I appreciate being up here. There's a lot of friendly faces in the room, so I appreciate that too. We've been coming to EnerCom for years, and the company has changed a little bit since we were coming as Earthstone, I don't know, Ray, back in 2014, 15. But how do you like us now? We've really transformed the company, and I'll go through a little bit of that story this morning and update for some of you, and maybe it's a new pitch for some of you, and some of you are going to be yawning because you've heard it a number of times. I've got some bankers in the room that have been very supportive of us over the past few years buying assets. I've got some BD guys that we've traded fisticuffs with trying to buy assets against one another, and so I really am appreciative of being up here today. I won't read you that. What differentiates us from others out there over the past few years is our job is to grow the company, transform the company, but really it's been to stay in business. It's to create a resilient, sustainable business over the last several years. And we've been a very strategic consolidator in the Permian Basin, focused in the Permian. It's got the lowest break-evens, and guys will argue that in other basins, and I agree that there are other basins that still work at $40, $50 oil, but the resiliency of the Permian Basin is what got us really excited back in 2015, 2016 when we started focusing there versus other plays that we were working on. So we've got a long inventory in the Midland and Delaware Basin. We've got a management team that's been together for a number of years, and we've been cycle tested. We're going to go through another one, folks. One of these days, oil's going down, and then it'll come back up. So don't fret for too long. And we love those opportunities as buying opportunities for us. Staying in business is really important, and the way we've always focused on that is committed to having low leverage. I'll show you a slide later on about all the transactions we've done and how our leverage creeps up. But every time we've done a deal, we focus on trying to get back below 1x leverage within 12 months. And so far, so good. It's worked out really well. As we've grown, as we've focused on free cash flow generation, not trying necessarily to keep production flat as we buy assets, that extra free cash flow goes to pay down debt, and sooner or later we'll find a way to return some of that to the shareholders when it's the appropriate time. And I've got a slide in here, as EnerCom talked about previously about ESG. We are focused on that, and there's some unique things when you're buying assets from private companies that we can make this world a little bit better by investing a little bit of capital when they were starved and weren't able to invest the right kind of capital to impact the environment. So just a quick corporate snapshot. This is pro forma for our Novo acquisition, which we'll talk about here in a moment, which we also hope to close tomorrow. Everything's on track, and that's why I'm the Lone Ranger up here, and Mark's not up here as well, because he's got to figure out how to spend $1.5 billion or wire money around. Austin mentioned that we've been pretty active. A year ago, we were up here at EnerCom, and then I remember going over to his office here and signing up the final pages closing document of that transaction. So it was Titus So it seems like this is an annual event for us. So, 12 months from now, I'll be back up here and signing something else to close. Once we get this thing closed, the fourth quarter will be a clean quarter for us, assuming we don't find something in between now and then, and we'll produce somewhere between 130, 135,000 BOE a day. I'll show a slide in a moment to show you that growth trajectory we've had over the past few years. The other highlight I'll point out here on this slide is we have an enterprise value of about $4 billion after we close Novo, and our proved reserve value is about $5.4 billion. So we're trading well below proved reserve value with a great inventory. Just some highlights from the second quarter and then some consistent growth that we've had over the past few quarters. But in the second quarter, we produced our peak rate that we've seen ever in the company, a little over 105,000 BOE a day. Adjusted EBITDAX was $239 million, and another quarter where we had free cash flow of about $42 million. That's 2 quarters this year in a row of about $42 million of free cash flow. Let me put that in perspective a little bit, though. The impact of price in 2023 versus 2022 is amazing. We had $500 million of free cash flow in 2022. A lot lower production, much higher prices. This year, we'll have another couple of quarters that probably are better than the second quarter, and we should end up with higher free cash flow, but it's not going to be the $500 million that we saw last year. Just pointing out on the right the production trajectory. We started post-COVID at about 15,000 BOE a day. 2022, you can see we were at 35,000. We did some acquisitions. You get to the fourth quarter of a year ago, after we had closed Titus, we were right at 105,000 BOE a day. We've done that for 3 quarters in a row now, and you can see the growth that we expect for the rest of this year. I want to just spend a moment on the Novo transaction. It is really transformational for us in New Mexico. The quality of the reservoir in New Mexico is one of the highest in the United States. We got our first deal there in early 22. The second one was a year ago. We had been out there looking for more opportunities. We came across Novo. It was a marketed process. We spent $1.5 billion on an 8/8 or gross total basis, knowing that we were going to use all cash, knowing that we didn't want to take our leverage too high. We brought in Northern Oil and Gas as our partner, and we did that from the very beginning of the evaluation. We were very like-minded, so they took a third of the deal for $500 million, and their check is coming today, I'm told, and we're going to pay the other $1 billion. So for us, it was a $1 billion transaction, fully funded under our RBL from a commitment standpoint, but about a week or 2 after we announced the Novo transaction, we went to the high yield market and pulled off a $500 million high yield offering, which termed out some of our RBL debt. So very important for us to get that debt in a manageable spot and give ourselves some liquidity if we run across something else under our revolver. So we'll have about $1 billion of liquidity that we can still go out there and look for assets. We are going to run 5 rigs, the same total we're running today, even with Novo. We decided as going into this acquisition that we were going to allow the production to come down a little bit. A lot of times these private equity opportunities are built up to sell, maximizing cash flow or some kind of multiple of EBITDA. Our job isn't necessarily to keep production flat. Our job is to create a lot of free cash flow to pay down debt. So we'll let the production dwindle a little bit going into 2024. Still going to be a big number for us, and pay down debt as quickly as we can. So prior to Novo, we were forecasting this year about 100,000 BOE a day. Like I said, we'll be 130 to 135,000 in the fourth quarter. Our CapEx was $750 million roughly going into the year. We're not changing it with Novo. Like I said, we're still going to run 5 rigs and let the production just decline just slightly. And we gained a huge number of locations, another 25% or so incremental locations, and we're up to about 1,000 locations. This asset was mostly in New Mexico, and that's where the lion's share of the value was, but there was an asset that came along with it in Culberson County. It's a little gassier asset for us, but we really like the economics, and even in Culberson, if we can get some gas price improvement. So again, we were out there searching for more growth. We were really focused on trying to grow in New Mexico first, get our footprint bigger, drives operational synergies. We're going to see some of those as we develop the asset further. It was a large deal that gave us scale, continued the relevancy of a public company. At some point, a $2 billion market cap company just doesn't get too many eyes on it, although I see lots of investors in the room today that I've had lots of conversations with over the years, but we continue to look for new investors and to generate interest in the stock, and scale is one of those things. I've talked about the free cash flow generation and how this adds to the strategy that we have there, and the inventory is really good inventory for us here, 200 high return, low risk development opportunities for us. And the last thing it does for us, it creates a more resilient, stronger Earthstone. And that is one of the things, we want to stay in business for a long time, and this was the attractiveness of this asset as well. Most of these I've hit on. I'll just show you on the right-hand chart there our leverage over time, going back to 2016, around 1. We have levered up over a couple of deals, and then we delever pretty quickly, like you see 2019, 2020, 2021, and we're back down to about 1 times or under 1 times today, and we'll be under 1 time 12 months from now. And you can see the EBITDA growth there, and what we're forecasting for this year is kind of shaded out, and next year as well. We expect big EBITDA numbers as we generate additional opportunities with this asset. So when you roll all this together from a high-level standpoint, we've got about 460 million BOE of reserves. You can see that it's 24% PUD, so that means all the upside locations, probable and possible, do not get included in that total proved value. And that's at strip pricing. And again, with the 1,000 locations, only about a quarter of them are proved, undeveloped locations. The rest of them are probable and possible. So we've got a great runway of inventory. And one more fun fact is we've grown from 0 to about 65% of our locations, close to 650 or 700 locations in New Mexico in the last 18 months. That has just been a strategic decision on our part to continue to grow there. It's not that we're disappointed in the Midland Basin, and we see some more opportunities coming down the road in the Midland Basin. We'll continue to focus there as well. But New Mexico has just been a true priority for us. All right. Okay, I hope somebody else can advance the slides, or we're going to go off memory here. Okay, thanks. Yeah, there we go. Let me back up one. Okay, I won't belabor this slide too much. We've done a lot of acquisitions over the last few years. You can see this on the right-hand side, 4 in the Midland, 3 in the Delaware. I think the key point is pro forma, we're 135,000 BOE a day. We've invested $3.5 billion now, and the acquired proved developed value, so producing wells and wells in progress, are about $3.6 billion. When you flip over to this next slide, $3.6 billion of proved developed value, that means we didn't pay anything for the locations. And you can slice and dice, and you can argue whether PV10 is the right multiple, but just on a relative basis, we've got 900 locations virtually for free. And that is the way we've built this company, and prior companies in our track record is to find ways to be creative. We bought deals when people were sitting on their hands back in 2021, and we weren't afraid of oil being at 40 because it wasn't going to last forever. And then we took a big jump into New Mexico with the Chisholm, Titus, and now Novo. Just quickly on the Novo from an asset standpoint, 200 gross operated locations. Again, Northern Oil and Gas is going to be our partner. We came into this asset evaluating it together, and one of the things that we quickly recognized and discovered is the low break-evens here in this portion of New Mexico. We took a look at the total basin over the last few years in terms of drilling and the average first-year cums, and then we looked at our own and self-evaluated. We're about the same as the entire basin with our assets, and then we looked at this asset here, and quite compelling to see that the cums in the first 12 months are pretty fantastic. A big chunk of this undeveloped inventory will come to the front of our inventory stack, and we'll start spending capital right away on this asset with the drill bit. One example I have here I want to show you. This is a 22 well pad that came on in early 22, and it took several months to come on altogether. But they drilled and developed 22 wells in a mile wide through 5 identified benches. They left a bench in the middle, which we call the break sand or the Harkey sand. We'll probably never come back to this unit and drill those wells. They're going to be influenced by the zones above and below them. But what you see here is this is the type of development we expect and underwrote the rest of the asset base. Of the 200 locations, there's 160 or so in New Mexico. The other 40 are in Culberson County, Texas. Different development plan there. But of these New Mexico-based development plans, these wells averaged anywhere, depending on zone, from about 1,500 to 2,000 BOE a day in the 70+% range of oil. The Wolfcamp B, being the lowest zone, is also the gaseous zone, and it's more like a third oil, but still very high rates. And this is what we, like I said, developed the rest of our inventory, and our development plan is all based on this. So you get great economics, really high returns, and very short payouts given the high initial rates on these assets. And these wells have been on for well over a year, very established decline curves. You can come in and drill the Wolfcamp B zone first. You can come back later and develop the rest of the zones, and that's what Novo developed most of their zones in the Wolfcamp B, or most of their wells in the Wolfcamp B first to hold the acreage, and lots of examples of folks who've come back later and no influence between the B and the upper zones. So we're really excited about putting a rig out here later this month or early part of September. As we've done a lot of acquisitions over the years, you find yourself filling up your garage or your house with stuff that you just don't need anymore, and or it just is non-core or doesn't fit, or good opportunities to move it down the food chain to other operators who can focus on it. And so over the past year or so, we've sold some assets just to clean house. First and foremost, those dollars went to pay down debt. There's some great operating efficiencies on our staff. We had one area that we had over 700 wells, vertical wells, that consumed a little bit of time to move those down into the food chain. Great valuation for us, and more importantly, the operational efficiencies that we get with our folks and utilizing them in the most appropriate manner. We'll continue to look at opportunities to sell down assets and move them out of our portfolio because we do have limited manpower. I hit on most of this already. We're a $4 billion enterprise value. We're trading at our proved developed reserves are $4.6 billion, so we're trading well below proved developed. Again, PDP plus wells in progress, and then I already mentioned what the total proved is. This slide is on our webpage, so I'm not going to belabor this too much. But over the last year, we have developed all the acquisitions that we've bought. We've drilled wells on. We even continue to drill on our legacy assets. We've drilled, of the 17 well or pads here, projects here, we've drilled 10 of them in New Mexico, 7 of them in our Midland Basin side. We've drilled in southeast Midland Basin in Erie County. Wells come in at over 1,000 barrels a day, BOE per day. High oil cuts. The oil declines off real fast. People don't like the southern Midland Basin. It gets a real bad rap. I can tell you it's very economic. It's shallower. It's got some reservoir engineering issues because of that, but you still get good economics. And then you move into New Mexico, and we're drilling wells that are 1,500 to 2,000 BOE a day, and the Novo asset is about where number 13 is on the map. And again, very prolific wells, and we're really excited to get some activity going there on our watch. One of the key things that Earthstone has faced over the last several years is private equity ownership. As we've bought assets and used 30% of, up until the Novo transaction, which was 100% cash, but we've used 30% equity in prior deals, we've given some equity to maybe non-traditional holders. And here recently, Warburg sold the last of their shares. They got shares through two different deals, our very first one in 2021, and then the Chisholm deal that got us into New Mexico. They had a total position of about 25 million shares, and in a year they have 0. So very good execution by Warburg. We participated in one tranche that they sold last October. They sold right before earnings, so we were sort of locked up. Couldn't buy any shares. Would have liked to have participated. But having them out of our stock, and they made quite a bit of money on the equity side, gives our trading liquidity a big boost, and that's always been a problem with smaller companies, so this really benefits us from a trading liquidity standpoint. Speaking of trading, we probably have one of the lowest 2024 enterprise value to EBITDAX multiples. I think as the Novo transaction gets closed and executed on by our team, I expect this to go up. And with the trading liquidity we got, that will help a bunch. But as you can see, especially related to the Permian peers, we're the lowest. And then there's a couple of peers that we're on par with that are non-Permian. So it's a great opportunity to invest in Earthstone. One of the things we've focused on is the right capital being spent on these private equity owned assets that were starved in some cases for capital and improving the world. We're spending capital to just retrofit old facilities, upgrade facilities so that we can minimize air emissions more than anything else. And we put out our first sustainability report this year, and a lot of effort and work, and hats off to Clay, Jean-Son, and Mark Lumpkin, who just belabored a labor of love here putting this report together. I'm not going to spend any time on company guidance. It's all out there publicly. I think the key is production is going to be 130,000 or so in the fourth quarter. We're going to let it slide off a little bit through 2024. We're going to spend $750 million. That hasn't changed. Hopefully next year it goes down a bit with some service costs reduction. Although if oil keeps climbing, between 85 and 90, I expect some of these reductions that we're expecting may not come to fruition. And then lastly, all the things I've talked about, we've made Earthstone a much more resilient transformed the company with great assets, great inventory, great runway, a very clean balance sheet, and a management team that knows how to go through the cycles. And so with that, I thank you very much.